Satoshi Nakamoto, the inventor of Bitcoin, could be one of the richest people on Earth. But many years ago, Satoshi had disappeared, and with Bitcoin being woven into the fabric of the financial system, solidifying its role as digital gold.
Imagine you're scrolling on your phone, half awake in the morning, and then you see the headline. The US government has just moved another massive tranche of Bitcoin into its official holdings. It's not a slush fund or some forgotten seizure wallet, they're calling it a strategic reserve. While the news screams inflation and recession, the people who actually move markets are quietly building lifeboats. If they're right, the next crisis won't be measured in bailouts. It'll be measured in Satoshis. Behind closed doors, a seismic shift is underway. Recent surveys show a stunning number of institutional investors are actively making plans to allocate significant portions of their portfolios to Bitcoin. The ultra-wealthy, the family offices that manage dynastic fortunes, are reportedly moving even more aggressively into the asset. So, what flipped the switch? It comes down to undeniable grade school mathematics. There will only ever be 21 million Bitcoin. Of those, the vast majority are already in circulation. And public companies alone have already bought up a huge slice of the pie. This leaves a rapidly shrinking pool of available Bitcoin for everyone else. When a single company, like Strategy Inc., announces another purchase of thousands of coins, the word scarcity stops being an abstract economic term. It becomes a pressing reality. For corporate strategists, it now feels less like a speculative asset and more like an essential one. While everyone was distracted by market fluctuations, something profound happened in the halls of power. Over the last year, regulators began to lay down clear, unambiguous rules for cryptocurrency. What was once a wild west of legal gray areas is now becoming a structured, regulated landscape. For the first time, massive financial players like pension funds, the guardians of trillions in retirement savings, can now gain exposure to Bitcoin without fearing regulatory backlash. The most significant green light was the SEC's approval of spot Bitcoin ETFs. That single decision acted as a starter pistol, unleashing a flood of new capital. They are managed by the biggest names in finance, like BlackRock and Fidelity. This transformed Bitcoin from a complicated direct purchase asset into something as easy to buy as a share of Apple stock. For most people in stable economies, inflation is an annoyance. But for millions around the globe, it's a catastrophic, wealth-destroying fire. In Argentina, the peso's value has been in a state of collapse, with annual inflation recently hitting devastating levels. Nigeria's currency, the naira, has also faced immense pressure, eroding the savings of its citizens. For people living through this, Bitcoin isn't a volatile investment. It's a lifeboat in a sea of monetary chaos. Don't think for a second that governments are accumulating Bitcoin just for fun. They are making calculated moves on a global chessboard. When China cracked down on Bitcoin mining and trading, it created a massive power vacuum. The United States, seeing an opportunity to dominate the next generation of financial technology, has quietly become the world's largest government holder of Bitcoin. You now have American politicians openly stating that securing Bitcoin within US borders is a matter of national interest, a way to ensure that the future of finance isn't dictated by its rivals. If you're finding value in this video, don't forget to subscribe and hit the hype button. Let's spread the word about crypto together and share this knowledge with the world. Other nations are taking notice and acting accordingly. Norway's massive sovereign wealth fund, one of the most conservative investment vehicles on the planet, has been steadily increasing its indirect Bitcoin exposure through corporate investments. And years ago, El Salvador took the pioneering step of making Bitcoin an official currency, a move that is still being watched and analyzed globally. This is a strategic repositioning as countries realize the global financial system is on the cusp of a monumental change, and they are scrambling to secure their place in the new order. The corporate world is governed by a powerful herd mentality. Once a few respected leaders make a bold move, others are compelled to follow. Tesla continues to hold a significant Bitcoin position on its balance sheet. Block, formerly Square, also maintains a substantial treasury reserve of the asset. Even companies far from the tech world, like Japanese gaming giants and American healthcare firms, have begun adding Bitcoin to their reserves. This has created a new dynamic in quarterly earnings calls. Analysts are no longer just asking about profit margins and revenue growth. They are pointedly asking, what is your Bitcoin strategy? A few years ago, the biggest career risk for a corporate treasurer was buying a volatile asset like Bitcoin. Today, in a world of persistent inflation, the risk is rapidly becoming the opposite. Every time another major company announces a Bitcoin purchase, it sends a shockwave through other boardrooms, triggering another round of dominoes to fall and further shrinking the available supply. The approval of spot Bitcoin ETFs in January 2024 was a game changer. In their first year, these funds attracted tens of billions of dollars in net inflows, a rate of adoption that outpaced even some of the most popular and established ETFs on the market. But here is the crucial detail. Every single dollar that flows in requires the fund manager to go out and buy the equivalent amount of real Bitcoin on the open market. This creates a relentless programmatic buying pressure that the market has never seen before. Financial advisors who in 2019 would have scoffed at the idea of crypto are now professionally obligated to understand it. They are increasingly recommending a small allocation like 3% as a hedge against inflation. While 3% may sound small, 3% of the multi-trillion-dollar global asset management industry represents a tidal wave of demand, aimed at an asset with a mathematically guaranteed scarce supply. Behind the massive numbers and institutional game theory are millions of human stories that reveal the true woman in Caracas who needs to send money to her son studying abroad. With Bitcoin, the funds arrive in his digital wallet before the local bank has even opened for the day, bypassing exorbitant fees and capital controls. Think of the coffee farmer in Vietnam who can now sell his beans directly to a tourist for satoshis, keeping the full value of his product instead of losing a significant cut to credit card companies or wire services. These aren't revolutionary headline-grabbing events anymore. They are simply part of a normal Tuesday for a growing global user base. Each person who uses Bitcoin to solve a real-world problem adds to the network's strength. They create another wallet, validate another transaction, and become another advocate for the system. This organic demand is the steady hum beneath the roar of the institutional rush, and it all adds up to more and more people wanting a piece of the same finite 21 million coins. While Bitcoin's core principle of scarcity is fixed, the technology built around it is anything but static. A vibrant ecosystem of developers is constantly working to make it more useful, scalable, and accessible. There are second-layer projects that enable stablecoins and other assets to run on top of Bitcoin, inheriting its unparalleled security. Other innovations are bringing complex smart contract capabilities, once thought impossible, to the Bitcoin network, allowing for sophisticated financial applications to be built on the world's most trusted blockchain. You even have the rise of AI-powered trading bots that capitalize on microscopic price differences across exchanges, adding liquidity and efficiency to the market in ways that were unimaginable a few years ago. Each technological upgrade, whether it makes Bitcoin faster, more versatile, or easier to integrate into existing systems, strengthens its fundamental value proposition. The technology is in a constant state of improvement, but the economic story remains unchanged. Every enhancement makes a strictly limited asset even more desirable. For years, the Bitcoin network created a predictable number of new coins each day. But in April 2024, a pre-programmed event known as the halving took place, permanently cutting the new supply of Bitcoin in half. Before the halving, miners were creating roughly 900 new coins per day. After the event, that number dropped to just 450. Now place that shrinking supply against the backdrop of surging demand. On an average day, a single one of the new Bitcoin ETFs might be required to purchase thousands of coins to meet investor demand. The math becomes alarmingly simple. The demand from these new financial products is outstripping the creation of new supply by a massive multiple. In any market, when demand relentlessly overwhelms supply, there is only one variable that can adjust to balance the equation: the price. and everyone is watching the same scarcity clock tick down. Gold has been the ultimate safe haven asset for thousands of years. When wars broke out, currencies collapsed, or markets panicked, humanity ran to the stability of gold. But gold, for all its history, has limitations in the digital age. It's heavy, difficult, and expensive to store securely, and you can't exactly send a gold bar through an email to settle a debt across the globe. Today, Wall Street has given Bitcoin a new nickname, digital gold, and the name is sticking because it fits perfectly. Gold has a market capitalization of over $14 trillion. To a new generation of investors, Bitcoin's smaller market cap doesn't look like a weakness. It looks like a massive runway for growth. You can verify the authenticity of a Bitcoin instantly, transfer $1 billion worth across the planet in minutes, and store it on a device no bigger than your thumb. It is, quite simply, a store of value designed not for a king's vault, but for the borderless, fast-paced internet age. To this digital native generation, a decentralized financial system run by transparent, verifiable code isn't a frightening concept. It's a logical evolution. Polls consistently show that younger investors are far more likely to own Bitcoin and other digital assets than their parents' generation. They aren't just investing in an asset, they are choosing to participate in a different financial philosophy. So as trillions of dollars in wealth are set to be passed down from one generation to the next, you have to ask yourself, where will that capital flow? Into the analog assets of the past, or into the native digital assets of the future? Now, it's crucial to be grounded in reality. The path for Bitcoin is fraught with potential challenges. Regulators in one part of the world could impose harsh restrictions tomorrow. A major exchange could suffer a catastrophic hack, or a global recession could trigger a widespread sell-off as investors flee to cash. These are real risks. But when you zoom out and look at the macro picture, the fundamental trend lines are clear. More people, more companies, and even more governments are adopting it. The network is becoming more secure and more widely integrated every day. The wild price swings, while unsettling, are a characteristic of a new global asset in the process of price discovery. Look at the evidence. Governments are now treating it as a strategic reserve. Corporations are systematically converting their cash into it, and millions of ordinary people worldwide are using it as a shield against the failures of their local currencies. That is why the world is scrambling for Bitcoin. Because in a system designed for absolute scarcity, with only 21 million coins, there will ultimately never be enough to go around.